Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
All right, let's just start with the numbers. The trading session ending Friday, February 6th, 2026, it told a story that the market's been whispering for months, but finally shouted. KODK, ticker KODK, it closed at $7.70. Now, that is a significant 4.9% jump from the previous close. We saw an intraday high of 780. But the number that actually matters to me isn't the price, it's the volume. Approximately 764,000 shares changed hands, and that is well below the 90-day average of 1.18 million.
Which is exactly why I'm so skeptical. I mean, you have a nearly 5% price surge on volume that is what, 35% lower than average? To me, that doesn't scream institutional conviction. It screams retail exhaustion and a total lack of liquidity. You're celebrating a price movement that happened in a vacuum.
I just see it differently. Low volume on a breakout like this often suggests that the sellers are simply gone. The supply overhang, the people waiting to dump the stock, it's dried up. That lower volume, to me, suggests high buying conviction from the few who are participating, maybe some short covering, and a lack of that retail churn. The sellers are exhausted and the structural turnaround is finally pricing in. So the question is this 770 the ceiling or is it the floor of a whole new era?
Okay, look, 770 is better than 734, I'll grant you that. But we are bumping our heads against a very, very serious technical ceiling. The resistance at 788, that's R2, and the long-term moving average at 787 are staring us right in the face. Technically, the long-term trend is still falling. So the core question isn't about one Friday session. It's, has KODK actually become a specialized industrial tech company, or is this valuation just being propped up by, one-time financial engineering events that won't happen twice?
It is absolutely a specialized industrial tech company now. And I'm glad you brought up financial engineering because I think that term is being used to dismiss what was actually a masterstroke of corporate strategy. We have to start with December 2nd, 2025. The KODK Retirement Income Plan, the KRIP reversion. This wasn't just moving money around on a spreadsheet. This was a billion-dollar unlock, a $1.023 billion total reversion. KODK netted $767 million, with $609 million of that in liquid cash.
I'm not denying the cash is real. The wire transfer definitely cleared. But a pension reversion is a non-recurring event. You can only rob the piggy bank once.
But it's not about robbing the piggy bank. It's about paying off the mortgage. They took $312 million of that windfall and prepaid their term loans. That May 2026 debt maturity, the one thing that's been hanging over this company's head for 3 years, is effectively neutralized. They've reduced the outstanding term loan balance to roughly $200 million. They have net cash exceeding $300 million. This is a fortress balance sheet now. And that's why we saw a buy signal on January 20th, and that's why the MACD is confirming the trend. The market is realizing this just isn't a distressed asset anymore.
I'm going to have to push back on the word fortress. A fortress needs thick walls, sure, but it also needs a functioning economy inside the walls to survive a siege. You're celebrating the balance sheet repair, which I agree was necessary to avoid bankruptcy in May, but let's look at the actual engine of this car. You are heavily reliant on a legacy business that is, it's slowly bleeding out. The print segment. It still makes up 65.8% of the revenue pie, $177 million in Q3 2025. And what did it do? It declined 3% year over year.
I'd call that stabilization in a tough market. A 3% decline in a legacy paper business is actually outperforming the sector trend.
The 3% decline is still a decline. It means your biggest revenue generator is shrinking. And just look at the credit rating. S&P Global still rates the issuer CCC+ with a negative outlook. Why? Because of weak free operating cash flow. You can pay down debt with a pension windfall, but you can't pay next year's electric bill or R&D costs with a windfall you already spent. You need operational cash flow. The 30-day implied volatility is 64.7. So sure, markets are pricing in stability, but they are not pricing in growth. They are pricing in survival. This whole turnaround is currently relying on a non-recurring event, not the organic growth of the business.
I think you're looking in the rearview mirror while the car is accelerating forward. You're fixated on print, which I admit is the cash cow, but you're ignoring the calf that's turning into a bull, the Advanced Materials and Chemical segment, AMNC. This is the new Kodak. In Q3 2025, revenue there was up 15% to $82 million. But the revenue number isn't even the most important part. It's the margins.
Margins are easy to maintain when the revenue base is small and you're just cherry-picking projects.
It's not just maintenance. It's a completely different business profile. The print segment, it operates on that razor and blade model, plates and inks. It's grinding out a 4.5% profit margin. $8 million in EBITDA, fine. But look at AM&C. It's boasting a 19.5% margin. That's $16 million in EBITDA on less than half the revenue of print. I mean, that is high-quality, high-margin revenue. Every dollar of revenue shifting from print to AM&C effectively quadruples the bottom-line impact.
Okay, I understand the math, I do, but I worry about the scale. You have this massive hole being dug by the print decline. $177 million shrinking by 3% means you lose over $5 million in top-line revenue. AM&C has to grow significantly just to keep the whole company flat.
And it is growing significantly. And this isn't just, film for Christopher Nolan movies anymore. We are talking about the news from January 26, 2026, the expansion into regulated pharmaceuticals.
The pharma announcement.
Exactly. The expansion into regulated pharmaceuticals at the new CGMP facility in Rochester. They're manufacturing PBS1X and water for injection, WFI.
Water for injection. It sounds like they're just bottling tap water.
You know it's not tap water. WFI is critical infrastructure for the entire biopharma industry. It requires unbelievably high standards of purity. Kodak is doing high-margin CDMO work, contract development and manufacturing. They are using their historical expertise in chemical layering and coating, which is backed by over 22,000 patents, and applying it to biopharma. This isn't a dying camera company. This is a burgeoning life sciences manufacturer.
Burgeoning life sciences manufacturer is a very heavy title to place on a company that just started shipping sterile water. Look, I acknowledge the margin differential. 19.5% in AM&C is impressive. But let's talk about execution risk. You mentioned the 22,000 patents and the pivot to things like battery electrodes with Ateo systems. That all sounds great in a press release. But moving from industrial film to FDA-regulated pharmaceuticals is a massive leap in compliance costs, in operational rigor. They are entering the CDMO space, which is cutthroat. You're competing with established giants like Lonza and Thermo Fisher. And about the batteries, turning coating expertise into battery electrodes is brilliant on paper, but can they scale it before the print business erodes another 10%?
They're already scaling it. The CGMP facility is online. They are pursuing ISO 1345 certification. And regarding the battery tech, that collaboration with Ateo Systems for electrode production is precisely the kind of niche, high-tech manufacturing where Kodak's legacy assets, their literal machines, and their chemical know-how give them a moat that startups just don't have. They don't have to build the factory. They are the factory. Their CapEx requirements are a fraction of what a competitor would need to spend.
Being the factory is expensive if you aren't running at full capacity. Those massive facilities in Rochester cost a fortune to heat and maintain. And that brings me back to the valuation. You seem to think the market has fully bought into this industrial tech narrative. But if you look at the peer group, it tells a really confusing story.
Actually, I think the peer group comparison is where the bull case becomes undeniable. We have seen a historic inversion in the market. Just look at Xerox Holdings.
I had a feeling you were going to bring up Xerox. It's the favorite punching bag for Kodak bulls.
Well, how can I not? It's the tale of two icons. As of early February 2026, Kodak's market cap is approximately $743 million. Xerox, they fall into somewhere between $266 million and $299 million, depending on the metric. Kodak is now worth significantly more than its biggest historical rival. Xerox is trapped. They have a 90.1% debt-to-capital ratio. They are drowning in the decline of office print. KODK has freed itself with a pension reversion. The market has decided. KODK is the survivor.
I'm sorry, but being the tallest dwarf isn't exactly a ringing endorsement. Beating Xerox right now is a very, very low bar. Xerox isn't a death spiral. So Kodak passing them is symbolic, sure. But does it justify a valuation of nearly $800 million for a company with a CCC plus credit rating? You're comparing a recovering patient to a terminal one and saying the recovering patient is an Olympic athlete.
It justifies it if you look at who they should be compared to. We shouldn't be comparing them to Xerox anymore.
Okay, fine. Let's look at who they should be compared to. If you want to be an industrial conglomerate, look at Deluxe Corp, DLX. They are valued at $1.19 billion. They pay a 5% dividend. They have a PE of 14.66. Kodak pays zero yield. Kodak has a negative trailing 12-month PE of minus 23.69. You are asking investors to pay a premium for a company that is losing money on a GAAP basis, while Deluxe literally pays you to hold it. Or, hey, look at Sumitomo Chemical. $5.76 billion cap. That's a real specialty chemical company. Kodak is trying to be Sumitomo, but it's priced like a distressed asset that just found a wallet on the sidewalk.
That wallet contained $1 billion, let's not forget. And the negative PE is looking backward at restructuring costs. The market trades on the future. The reason Kodak is commanding this attention and why the volume is so tight is because the leverage is dropping. We are looking at adjusted leverage dropping to 7.8x by late 2026, down from over 25x in 2024. That is a massive de-risking event, and frankly, the market inversion with Xerox proves that investors see the clean balance sheet as a launchpad.
A launchpad needs fuel. And that brings me to the institutional flows. You mentioned the low volume suggesting conviction. I see a different story in the ownership data. I mean, if this was such a sure thing, why is the smart money acting so conflicted?
You have high insider ownership, somewhere between 23.87% to almost 41%, depending on how you count the options and structures. But look at the specific transactions. CEO James Continenza bought 50,000 shares in late 2025. That was an open market buy.
CEOs buy for optics all the time.
Okay, fine. Then explain the CFO. David Bullwinkle exercised options in January 2026. And this is crucial. He retained the shares. He didn't just dump them for a quick payday to cover the tax bill. When the CFO is keeping the stock after an exercise, that tells you he believes the internal numbers look better than the external sentiment. He knows where the bodies are buried, and he's betting on the resurrection.
Insider alignment is good, I'll grant you that. Continenza and Bullwinkle has skin in the game. But look at the institutional smart money. It's a mixed bag at best. Yes, Comerica Bank increased their position by over 3,000% in January. That's a bold bet. But look at the other side of the ledger. First Eagle Investment Management reduced their position by 21.6%. UBS Group cut their stake by 18.2%.
That's just rotation. Funds rebalance.
It's not just rebalancing. It's a lack of consensus. If this was a slam dunk structural pivot, you would see universal accumulation. Instead, we see major players trimming their exposure. And look at the social sentiment. I tracked the chatter on Reddit rstocks, Ranalog, and StockTwits. It's being viewed as a defensive rotation. It's a niche play. It doesn't have the viral volume of a top-tier stock. It's not an Nvidia or even a Palantir. It's a dusty stock that people are trading because they think it's safe-ish, not because they think it's the next big thing.
36th percentile of its annual range. The meme energy is gone, and that's healthy. Now it's about execution. The X platform, formerly Twitter, shows spikes around the pharma news. The priority tab algorithm favors them when they drop real news. This is becoming a serious, boring, profitable company.
Profitable is the word we are arguing about. They have operational EBITDA, sure, but the free cash flow is still the major concern.
The cash balance is over $300 million. They have the runway to get to profitability. They don't need to go to the capital markets for dilution.
Let's bring this to a head then. We're sitting here in February 2026. The stock is at $770. You believe the pivot to AMNC and the pension cash has solved the puzzle.
I do. The balance sheet is resolved. The debt maturity in May 2026 is effectively prepaid or at least manageable. They have the cash to fund the pharma growth without going back to the market. The higher margins in AM&C will overtake the volume decline in print. It's a mathematical inevitability if they execute.
And I look at that same 770 and I see a trap. You have a company that is essentially a startup, the pharma and battery division, attached to a melting iceberg, the print division. The startup is growing, yes, but the iceberg is melting fast. A 3% decline in revenue is not negligible when it's 65% of your business, and that technical resistance to 787 is significant. If they can't break that long-term moving average, the algo traders are going to sell it right back down to the 720s.
But if it breaks 787, if it breaks 788?
If it breaks 788 with volume, then we can talk about a trend reversal. But until then, the long-term trend is technically falling. The burden of proof is on KODK to show that this pharma expansion isn't just a science experiment, but a real revenue replacement for the dying print business.
I think the burden of proof has been met by the $300 million net cash position. That buys them time, and in this industry, time is what allows the patents to monetize. The Xerox flip is the signal. The old guard is dead, the new KODK has emerged.
We will see. The next few quarters are going to be absolutely critical. We need to see if that May 2026 maturity clearance actually leads to better credit ratings, or if S&P keeps them at CCC+.
Fair point. We'll be watching the tape.
Indeed. And for everyone listening, keep your eye on 787. That's the line in the sand.
Absolutely. That concludes our debate for this week.
Until next time.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.